here, and I wanted to come in live for you guys. We've have a lot going on, and there's a lot of business that's being facilitated right now, and we just actually dumped another $29 million project on our books, and people are sitting back going, Jerome, it's wartime. Don't you know that there's uncertainty in the marketplace? And I sit back and say, yes, I do know that there's uncertainty in the marketplace. And one of the biggest things is knowing where to get your information. And so a lot of what I do is not look at research and stuff that's happening. I don't look at what's happening and trending on the news. I look at actual real data based on what's happening economically with the largest companies. So when I go in and I look at companies like Blackstone and I look at what they're doing, I listen to their national economists, or I go in and I listen to the National Association of Home Builders, and I try to recognize what's happening during these war times. And I wanted to find out what the best markets are in this wartime. And so I want to go over that with you guys today. And some of you guys sitting around going, Jerome, what gives you the ability to be a professional in this industry? Well, I've been developing real estate just like this, behind, like the real estate behind me, for the last 25 plus years. And we're doing hundreds of millions of dollars in takedowns. In fact, this year we'll do over $100 million in real estate development, and we build and hold. And one of the big things is that I want to know that for my employees, my staff, for our investors, for people that are working around us, our inner circle, that we have a protected asset class. And if we don't, I want to be able to migrate, pivot, and move out of that asset class. And so a lot of people sit back and they look at what's trending on the news. They look at what's going on the big networks, Fox, NBC, CNBC, ABC, CBS, and all the large networks. Now, those are all rating based. I don't want to go based off of rating based. I want you guys to have real information, documented information of what's happening during these war times, times of uncertainties, right? And there's a lot of different ways that this can pivot and turn. But optimistically, we hope that the people that lead us, lead the country, lead the world leaders, are actually leading us in the right direction. And so when we look at where we are as a nation, that's what's most important, is where we are in the United States right now. And so the United States, we have this arbitrage of $6 trillion that's out in the market stimulating our economy, right? That was our stimulus package. And one of the big things is that most countries don't have that. We were able to go in, print cash. So we have over $6 trillion trickling through our economy right now. And that's sitting on the balance sheets of large corporations, our banks, and individuals. End users' homes right now. So all of our balance sheets are bigger right now. One thing that people forget to remember is how well the labor pool is in the United States right now. So when we think of markets like Austin, take for example, which is our number one market right now during war times. What gives Austin that ability to have such growth during uncertain times? Well, their economic growth has been so incredible, their labor pool is so incredible, that Austin is still one of the number one markets. Number two is Tampa. Tampa right now during war times is the number two market. And so before I go on to the other top five markets in the United States, why are these places doing so well? And why as a nation are we doing so well right now? And one of the biggest things, you have to look at our balance sheets, where we are as a nation and where we are individually. And I think what people fail to remember is where we were pre-pandemic. We were still sitting very strong economically pre-pandemic. And if you guys remember that people were talking about being in a bubble pre-pandemic, stating that we were at historical highs and we were expecting a recession, including myself. We were looking for something to give in the housing market. But then during the pandemic, interest rates went down. The feds came in and said, hey, let's help out our American people. Let's lower interest rates. And at that time, we were underwriting deals just like this apartment complex behind me. We were underwriting projects just like this at like a 6 cap pre-pandemic. And then as we moved through the pandemic, all this stimulus money was printed and entered into the US economy. And we started underwriting deals like this at sub 4% cap rates, like 3.5% cap rates. And this was going on nationwide. Now, when I say we as investors. Myself, I wasn't underwriting these things at 3.5%. I've never underwritten one for under 5% because I knew that there was a limited amount of time that 3.5% could hold for us. And knowing that in construction and real estate development, I don't want to get stuck on a 1 year, 2 year, 3 year project where the market goes down, we underwrite it really low, and then all of a sudden it slowly starts to climb, and then we're in a bad position. So I always exercise my underwrites on caution, with caution, and exercising worst case scenarios. And so you got to understand that right now the US economy is doing better, even in spite of interest rates going up, than we were doing pre-pandemic. And so where interest rates were right around 5%, we're down. Interest rates went down to a historical low of about 3%. Just you can get a 30-year fixed mortgage for like 2.9% in some with some banking institutions, but we're sitting still right now under 4% on a 30-year fixed loans. So we're still sitting at a very good place. So even if interest rates go up by 1.45 different times this year, we're still going to be under 5% on our interest rates for a 30-year fixed loan, traditionally for somebody who has fair market credit, over a 700 credit score. And so understand that when we look at this and we're underwriting stuff, you have to look at where interest rates are going. And we also have to look at what's happening with appreciation on those assets, which have so far have superseded where we are as far as inflation. And so one of the big topics right now nationwide is, Jerome, if inflation is going up so much, how can the American people be doing so well? And how can our balance sheets be doing so well? Well, you have to look at the labor pool. And right now, everything that's happening, when you compare our labor pool and how people are doing economically with what they're making and earning, it surpasses where we are in regards to inflation and mortgage interest rates. So when you run a parallel between those three, you'll see that economically, we are still doing better per household income than we were 2 years ago in comparison to where we were economically. So people look at this, I don't think they look at it in three parallels. They look at it in two parallels, but there's a third side to it. People are looking at just inflation and they're looking at interest rates, those two things. But when you look at it in parallel with just interest rates and inflation, you're forgetting about our labor pool, and you're forgetting about where we are as far as payroll and where people are economically. And right now, economically, our U.S. American people are earning more. That stay-at-home business model has come in extremely aggressive and well for most American households. And so what's happening is people are going, U.S. American households are working from home, businesses are saving on labor pool, they're giving it back. Businesses are very affluent right now, and they're giving that back to the end user. So when you look at the national household income, where it came in the last 2 years, where interest rates have come in the last 2 years, and where we're projected to continue progressing, and when you look at inflation, the labor pool and household incomes have risen more in parallel to those two items, side by side. So still, as Americans, we're still doing extremely well. Now, let's talk about this. So we have Austin, we have Tampa. Raleigh-Durham is still number 3. It came from number 1 down to number 3, but still in the top 3 most lucrative markets in the United States. And Nashville, Tennessee is number 4. I'll give you number 5 here in just a minute, and I'll even give you the next 3 in line behind number 5. But look, ladies and gentlemen, we as Americans can come out of these war times very, very lucratively if a few things happen. Now, I can't sit back and poke Biden on the shoulder, and I can't talk to our world leaders like Putin and these guys, but I think that these individuals are smarter than we think in certain aspects, not in all aspects, but in certain aspects. And I really believe that Putin isn't as ignorant, and I don't even know that it's more about power, because Putin already has power, right? I think it really has to do with money. I think Putin just loves money, and I think a lot of what's going on right now has to do with the fact that Putin loves money, and I believe that he's going after what he can to be able to generate more capital for himself, selfishly enough. And so if the war ends pretty quick here, within the next 6 months or sooner, the U.S. is in a really good position, because we are the only country right now that has over $6 trillion in reserves. And that was obviously printed. It just kind of came out of nowhere, out of thin air, you can say. But we printed $6 trillion, and that's pumped into our our U.S. American economy right now. And so we're the only country that has that type of affluency in the entire world. Okay, now on top of that, when you look at agriculture and you look at Ukraine being one of the largest producers of grain and wheat in the world, and you sit back and you look at some of our world economic leaders, like Bill Gates, like him or hate him, he's still the largest owner of agricultural farmland in the entire world. And so when we look at what the wealthy are doing, what's happening right now with Ukraine, the United States can walk out of this stronger than we ever have been economically, because we have the resources here to take on what we are going to be losing from Ukraine. About 15% of our wheats and commodities come in from the Ukraine. So wheat and so a lot of our wheats and grains come in from there, but only 15%, which we have the ability to produce in excess of that right here in the United States. So if our government leaders, our tax writers come in and say, hey, look, if we give agricultural rebates to the farmers, which I believe will happen, and I believe that this stuff is already in talks, and they say, look, let's give them tax abatements or tax rebates or tax credits for those people who go out and they farm. And we produce the excess wheat that we need. We no longer have to bring that in from the Ukraine. We can produce that right here in the United States. And economically, we don't even have to have that foreign trade agreement with them anymore, and we could just do away with it. Now, our hearts and blessings out to the people of Ukraine. But right now we're sitting back going, okay, how do we pick up the pieces from this? The entire world's going to be affected. And so when you look at the country as a business, you have to look at it economically as a business. And the problem is our government doesn't run like a business. If any entrepreneur ran their companies like our federal government, you would be bankrupt. Okay, so understand that in spite of how good we believe the United States runs, if we were as wasteful as our federal government or even our local state government, every business out there in America right now, all the practices that we function with as entrepreneurs, we'd all be out of business. So understand that as U.S. American people and business and entrepreneurs, we say, okay, can the government get it together and run this country like a business? That's why a lot of times it's nice to have a leader that has business background, business smarts to be able to go in and run our country. And so if we went in and we exercised our agricultural abilities here in the United States, we wouldn't need Ukraine. Now, oil, crude oil. Let's talk about crude oil real quick. We have one of the largest pipelines moving from Canada all the way down to the Gulf of Mexico. It's called the XL Keystone Pipeline, and it was shut down. It was opened up by during the Trump administration and shut down during the Biden administration. In fact, that was shut down the first week of the Biden administration. But understand that if we open that up, we don't even have to we have enough crude oil right here in the United States that we don't even have to go overseas to bring it in. So all of these oil prices and gas prices that are going up exponentially right now, ladies and gentlemen, we could fix that very well. If we could get our Republicans and our Democrats to come together in agreement and open up the Keystone XL pipeline, understand, I know there's environmentalists out there right now that are saying, oh no, Jerome, that's environmentally polluting, pumping oil out of the ground. Understand that more economic resources are put forth, and there is more environmental research and there's more environmental research and studies done to the XL pipeline than any other sector in the environment. There is more free radicals that are let off by wind turbines than there are from the XL pipeline. There is such little discharge and free radical discharge from that pipeline because of how much inspections and how much regulations are put on it. Most American people don't realize it. They just listen to Fox and NBC and CBS. But if you actually do the real research as to how much pollution is put forth by the XL pipeline, Keystone Pipeline, it's almost nothing. It's very, very, very little. There's more free radicals put into our environment and into the air from wind turbines. Do the research. Now, look, ladies and gentlemen, if we did this, we would increase job growth for sure economically. We would decrease the price per barrel locally. And so our crude oil prices, which means at the pump, and everything in our paints and construction supplies, all of that PVC, everything that's produced with crude oils, the prices would come down exponentially. It would create job growth and economic growth from the Canadian border all the way down south to the Gulf of Mexico. And where are these people that have these housing needs going to live? They need houses. They need apartments. They need stuff like this that's right behind me here going up to be able to service that. So we're going to benefit. And then all the small business owners that supply the materials, the supplies, the furniture, the window coverings, the food, the flooring, all of the construction materials to build that house and everything to furnish that house and have those single family homes produce, everything economically starts to expand and it goes back into our U.S. economics. Okay, so we have the ability right now to take care of everything that's happening in regards to all the negative stuff that's happening in the Ukraine and the war with Russia. And we have the ability to overcome it economically right here in the United States. Now, I believe that our national leaders are at least smart enough to see what I see from the outside looking in. And so if they on the inside can see what we're looking at and we're able to go in and utilize our natural resources here in the United States, we could walk out of this truly the most affluent nation than ever before, because we're already one of the most affluent nations. But imagine where we could be if we just exercise some of our natural resources, as I'm talking about in the video. Now, if you like this content, you want more information and more content just like this, click the like button, click and subscribe to our YouTube channel, and you'll always get notified and updated anytime I do research and update and videos just like this one. Now, number 5, hottest retail real estate markets during war times is Denver, Colorado. That's our number 5 hottest market, followed by Cleveland, Phoenix, and Jacksonville. And you know what's funny is that when in my network marketing days back in the 90s, I had offices in Texas, Colorado, New Mexico, Florida, and Virginia. So I got 3 out of the top 5, right, that we're in here. And still very affluent markets. They were affluent back then, they're affluent now. And so, ladies and gentlemen, if you want to invest, you're an investor, you want to buy land, build houses, understand that this is a very strong economic point in our economy. The housing market is still doing very well. Don't look at things in parallel to just inflation and interest rates, because that's what most people are doing. I got these stats from BlackRock. You can go in and you can Google current BlackRock projections for the real estate market, and they're still saying single family homes is the #1 asset class to be investing in right now. So if you want to be investing in real estate, you want to be able to buy land and build houses and put stuff like this up that we're doing right behind us, that's the best asset class you could build in, is multifamily and single family dwellings, ladies and gentlemen. It still surpasses retail, office, now office warehouse being an exceptional asset class because of what's happening with e-commerce. That's an exception to it. But ladies and gentlemen, BlackRock still believes that the #1 asset class in the United States is single family homes. The problem is that they're saying that we're looking at in a parallel between interest rates and inflations, and they're forgetting to look at it on a third level, which is economic growth and average household income, which have went up exponentially along with the pandemic and along with inflation and along with with interest rates. So, ladies and gentlemen, don't go out and sell your home and flee the country. Don't go out and stop buying land and building houses. If the big investment REITs, the largest in the country, are still going out and purchasing real estate, you should too. When you should stop is when they stop, because then obviously they know something that we don't. But until the big guys stop investing, you yourself should go in and continue buying land, building houses, buying and building multifamily, or doing fix and flip and value add projects. But ladies and gentlemen, top 5 markets: Austin, Texas; Tampa, Florida; Raleigh, Durham, North Carolina; Nashville, Tennessee; and Denver, Colorado. Click and subscribe. Ladies and gentlemen, thank you guys for joining. We'll see you next week on Wednesday's Real Talk on Real Estate. Thank you and God bless. Go out and compound your success.